The sort of areas I'm going to cover are as set out in the slide. One of the more important factors that we find is the whole value and worth scenario. It gets very confused, and I'm going to spend a little bit of time on that. But essentially, this is a Why London type presentation, and picks up what's been going on in the equity market here. So what got us here? I think we've seen a number of discussions this morning that is covered with what's been happening with the virtualization of what's been called big oil. The 1999 oil price collapse created virtual oil companies in a large number of ways. The development of increasing and diverse competitive services sector and new technology. I think all of those factors, I think, have been well discussed, I think, today. The fact that costs and technology have driven fundamental change in the industry. And in a number of cases, such as the North Sea and other various jurisdictions, the majors who had a firm hold on acreage made the acreage available under various different regimes. I think you've seen this curve a number of times today in various forms, but it's incredibly dramatic. The E&P boom in the period 99 to the global financial crisis collapse drove an incredible impetus with regard to the number of oil companies. Remember, the AIM market was coming into its fruition around that time frame, and with the release of people, the virtual oil companies created a dynamic that saw many hundreds of oil and gas companies listing in a variety of jurisdictions, including the London AIM market. So the international independent sector has been buoyed by the oil price. The oil price obviously affected returns, made fields economic. Basically, the whole industry was turbocharged by that, and effectively helped create an independent sector that hitherto did not exist outside some of the more traditional independent markets. And as part of that process, each of those companies needed access to a more sophisticated level of financing. So that led to a range of different financing tools available in various marketplaces. You've seen that, and of course, the global financial crisis saw a correction, and then a correction which clearly saw a movement down to a completely different level, and just right, got it. But what we're seeing in the last 18 months since the oil price collapse was a stability coming back into the market, and certainly the forward curve is at $50 oil plus has seen a very positive impact on the market as we see it. Financial liquidity is the lifeblood of E&P. Every oil and gas company needs financing. Clearly, whether you're a shell or a cash box or an exploration appraisal, equity remains key. A variety of other sources become available to you once you move into appraisal, pre-production and production, which clearly equity still remains important. The risk profile influences liquidity and sources and costs. Clearly, one of the things we'll talk about later is the sort of cost profile, the return profile that people expect. For junior E&P, creativity is key, particularly at this point in the cycle. Equity still tends to be the starting point for most of these things. Right. As E&P matures, the equity profile becomes less important, but it still becomes a key determinant in funding from exploration through to production. The sort of returns, now we can dispute the actual returns that people are looking for, but the reality is in a very volatile market, as we've seen, the equity returns for both private equity and conventional equity are quite high. And with mezzanine and others being the luxury, I suspect, of production and firm revenues. Once you have revenues, then clearly your cost base and risk return profile changes considerably. The London market has stepped up, I suspect. As I said, we mentioned AIM previously, but the London market has stepped up in terms of what it can offer, the funding for E&P. I'm going to talk more generally about the London market, both in an E&P sense and in a more general sense. But London is open for business and has been over the last 18 or 20 months. But it does value risk. You may not like what valuation you get for your underlying company, but it still values risk all the same and allows you to raise money. So we've seen situations where across the board, and at this point in the cycle, you would expect exploration and appraisal to be funded, less so than production. And a lot of the funding was to repair balance sheets. A lot of the funding was to deal with development and appraisal assets, although increasingly we're seeing exploration being funded as well in over the last 12 months, since the Brexit debate. Deep liquidity across the funding spectrum. Again, there's a variety of different sources available to different categories of companies. This is just the London market generally. This is courtesy of the London Stock Exchange, but basically what it highlights is that by number of deals and by the amount raised, London still is a very important market. This is across all sectors. These are the points that the London Stock Exchange make, I think, with regard to why London remains a premier financial sector. I think what's important here is the provision of additional liquidity. We've seen a number of dual-listed companies come here, and then when you look at the dual listing, you find that liquidity tends to be enhanced by being listed in London. There's a natural history towards dual listing and companies coming to list here, international companies coming to list here in the oil and gas space. And the AIM market and standard listing processes have stepped up in terms of providing a mechanism by which listings can occur. And one of the things that's happened since the Brexit debate in 2016, the Brexit decision, is that funding has continued and activity levels in London have continued to expand, which is encouraging. So again, this is the number of international issuers. Again, London stacks up very highly. By international, it means people who are listed here in London but have assets internationally, and vice versa. And of course, across comparisons, it does very well. So it's attracting international capital even now. If one looks at the liquidity argument I mentioned earlier, London tends to have superior liquidity over a 6-month period compared to most of the other dual-listed locations. And London continues to attract a number of international investors against other stock exchanges. Now, the sound of Brexit. Apologies to the Von Trapps and for the Remainers in the audience, but what we've found with the Brexit impact is that the opportunity for internationally focused companies to list here has not been curtailed. The 2017 activity levels tend to debunk any of the Brexit concerns that we might have seen. 93% increase in main market IPOs versus first. Again, this is across the market. This is not E&P. Oops, I've gone again. 39% increase in main market money raised versus first half 16. And the number of listings from certainly North American companies listing here has gone up by a considerable amount. What we have found in the E&P oil and gas sector is that raising money for companies when the oil price is moving above $50 is certainly realizable. $50 has become a watershed against which E&P companies can raise capital, and certainly the market is open and has been open over the last 18 months. So London equity market has been open for business with a surge of oil and gas activity. Over the past 18 months, there's been $2 billion raised in London for E&P. A number of those are some fairly high-profile listings. In Q2 2017, £573 million was raised. At no point in the cycle did we expect the funding focused on. At this point in the cycle, we expect production to be the main focus, but we've seen a wide range of activities, and increasingly we're seeing more exploration being funded. Things like Echo Atlantic, well, excuse me 1 second, 22. We've seen Faro, Providence, Savannah, various other companies raising funding for a broad range of both appraisal and exploration assets. Value versus worth. This is an interesting concept, but most of the time we come up against companies that want to IPO or raise capital, and they refer to their NPV 10 value or whatever. And we tend to have to sort of bring them down to earth and say, well, the market will value risk, but it will value it on its terms. London is open for business, but unfortunately the value you get may not be what you want, but it is open for business. So value is one thing, and then worth, what someone will pay for it, is something else. And there's just some interesting statistics we've been able to pull together. This is a correlation of the work that our research team has done in relation to the sum of the parts valuation of E&P companies using typical industry type valuation measures against the enterprise value. And what that tells us, and it correlates back to some companies where we've done detailed NPV, the triangles are detailed NPV 10, detailed discounted asset value models. And that correlation works very well. What it highlights is that typically most independents at the small end of the market tend to trade at 35 to 50% of their NPV 10 type values. Now, that may sound modest, but it's a fairly good measure at this stage. Exploration is very much at the bottom end of this process. The production companies, i.e. the majors who have revenue based, that 35 to 50% discount tends to sort of increase, and they tend to move up more towards parity over time. And again, it's very much cycle dependent, oil price cycle and market cycle dependent. This chart looks at the reserves versus the enterprise value and says the market's sufficiently smart enough to actually differentiate between liquids versus gas and fiscal regimes. So the red squares are gas in Russia, the blue triangles are oil and gas in North America. Again, highlighting the differentiation between the two. This is a case study my colleagues have put together, which looks at an exploration company that IPO with prospective resources. The first well in a 2-well campaign was drilled. It was a dry hole. Clearly, it was penalised for that. It fell back both in terms of its reserves and resource values and its enterprise value. It then drilled a second well, made a discovery. It moved to appraisal, and eventually was first oil delivered and eventually acquired. That happened in the pre-global financial crisis, that particular example. In a post-global financial crisis example, we saw a situation where a company floats with contingent resources and small reserves. It various appraisal wells. It moved towards production. Second asset reserves were booked. Unfortunately, the management team were embroiled in a corruption scandal. That corruption scandal in a far-off land led to an eventual downward re-rating. The CFO at the time did not have in place sufficiently good protection mechanisms in place for the asset base. With the results, the creditors ended up foreclosing on the company, and £1 billion company disappeared from the market. So again, failure is punished, and debt must be managed. But certainly the market and the valuation mechanisms by which we look at these things, deliver sensible results normally. Wrap up. The independent E&P sector has been transformed by both technology and service costs, IC restructuring, and funding from equity markets such as AIM and some of the other international markets. London is best placed to access sophisticated investor across all liquidity services, across the range of financial liquidity products. Investors value and reward success, but price in risk, and that risk may well result in a risk and value gap, which may or may not be acceptable to various parties. E&P in London is in good health. It's currently we're currently funding exploration as well as production. Again, in moderation, but it is now coming forward and it's being supported. And the London market and equity investors support E&P in $50 oil, I think, is the punchline that we started this presentation on. In terms of us, SP Angel is a leading resources broker advisor here in the London market. We cover the range of products and services you'd expect. We have in excess of 40 retained clients. We are the leading nomad in the mining space. We have a growing oil and gas client base. And finally, the mugshots. Richard Redman, I think most of you heard speaking this morning. My colleague Zach Phillips is in the audience. And our sales staff, Richard and Elizabeth, have been around and about today. I'm sure you'll see them. If we can be of any help to you during this week, while you're in London these next few days, we'd be happy to help. I think we bring a level of both industry knowledge and market knowledge, which is, I think, from your point of view, helpful because we understand your business. And we had thought of changing Zach and Elizabeth's name to Richard, but we decided otherwise. Yes. Thank you.
Thank you, Richard.